This is the launch of the Exact Macro Market Monitor. I've got a subscription newsletter here on Substack, and you do get the weekly outlook for free, the market outlook each week, which will be published on Mondays. But if you want the signal service, there's going to be a boom bust alert service for U.S. stocks and the U.S. dollar. If you want those warnings when they come up based on my proprietary model, you have to subscribe for $10 a month. It's a great deal. What's scarier than a market crash, and what's more opportunistic than to take advantage of a big increase in the market if you're going to go long? So this is something that I'm going to talk about quite a bit in coming videos, and I'll give a brief introduction here. This is based on a proprietary model that I use that not only relates with precision changes in broad stock indexes like the S&P 500 into changes in GDP growth and vice versa, but also I have a proprietary model that produces signals that indicate large market movements up or down, and the magnitude of those movements, not just whether we're going to have a big movement up or down, but a good estimate of how large the movement's going to be. And it doesn't just apply to the S&P 500, which would be great enough, but it also applies to most individual stocks, about 80%, with pretty high precision, and I'll demonstrate that over time. And that brings me to a question. Which stocks? I think initially I'm just going to have a list of widely held stocks, and when there is a market alert, I'll have a prediction for the movements in those individual stock prices. Which ones would you like me to cover? Let me know in the comments below, or go to my Exact Macro Market Monitor newsletter site. That's exactmacro.substack.com. Link will be in the description. Go there and let me know in the comments section. Right now, I'm going to start with these stocks: Apple, Microsoft, Google. You can see the list here: Tesla, Facebook, and you guys let me know what you think. Now, my first post on the monitor is up, and it's about the market outlook for the coming week. Happy Thanksgiving, by the way. I don't expect anything. I mean, aside from any unexpected news, I expect the slow recovery to continue. And what do I mean by recovery? Why do I say slow recovery? And I mean in the markets and the economy. Well, the evidence seems to indicate that we do have a recovery going. For example, the yield curve, the 10-year Treasury minus the 2-year Treasury rate, it's been rising, and it's been rising consistently throughout the year since the market, since the aftermath of the market crash, as you can see. And then we have the 5-year forward inflation expectation rate, which uses TIPS, and that's also been rising. We've been going sideways for a while here since about the 1st of June of this year, but we still have a slow recovery underway at a below target inflation rate. Unfortunately, the Fed's target is 2%, and we're slightly below that on average since June of this year. And of course, that's good evidence that we have a slow recovery as opposed to a healthy recovery, unfortunately. And then this is the kind of graph that, as far as I know, only my service can provide, where I translate changes in the S&P 500 into expected GDP growth year over year. And this is done using the discount rate on the S&P 500, and I can go into detail on that sometime, but for now I'll just talk about what this graph shows. So as you can see, in December, before we started this market decline, we were up almost 1% over the prior year in terms of GDP growth as expected by the market going forward, and then we fell all the way to more than negative 1.5% in March of this year, and we've slowly recovered, and now we've been hovering Since about August, the beginning of August, we've been hovering at negative 0.5%. Um, so, so in terms of GDP growth, we're actually below where we were last year. And that indicates that the neutral interest rate, just to get back to where we were before the COVID crisis began, the neutral interest rate is about 1.5, or I should say the Fed funds rate should be dropped almost 1.5% in order to meet the neutral interest rate and spur a recovery back to the level we were. And actually, even back in before this COVID crisis, we had not fully recovered from the effects of the trade wars and the tight monetary policy that followed. So that's the outlook for the week. I don't expect a lot of changes. Obviously unexpected news is what moves markets. So if I see anything in my proprietary model that indicates that there's going to be a big market move, I will of course provide alerts for those who subscribe to my to the paid service, and it's only $10 a month. A lot less than the price of a cup of coffee each day, just pennies a day, and you can find out when major market moves are coming, in most cases, before they occur. The system I have is nothing is 100% effective, but it's very close, and it's the best that I've seen. Comments or questions below, and I hope once again you all have a fabulous Thanksgiving.